Banks' profits are down. Let's have a look. Good afternoon, everyone. I'm Florian Heiser, and welcome to another episode of Heiser Says. I'm having a relaxing Sunday with my stein of coffee before I settle down for some work tonight, and I thought we would have a read through this article about the big four banks, and their profits are down. I know my heart aches. My heart aches at the thought of the big four not making a huge profit, but you know, we have to accept it, guys. We have to accept it. What do you think, guys? Are you disappointed? So, Banks' messy result will not cloud the not-so-pretty picture. Messy and a complex set of numbers are two descriptions pinned to the bank's mini reporting season starting this week. The messiness comes from a whole lot of one-off book entries, divestments of wealth and insurance businesses as the banks try to shrink back to being banks, and of course the ever-mounting bill from years of misconduct. These one-off items make it tricky to see how banks are going compared to previous years. But stripped back to their underlying cash earnings, the bank's preferred calculation, it appears they are no longer in the groove, more like a rut. The aggregated underlying full-year cash profit for the Big Four is forecast to come in at around $27 billion, down 9% on the $29.3 billion last year, and another step down from the peak profit of $31 billion in 2017. Worryingly for the bank's top-tier line revenue, the important income bit is shrinking too. There are unlikely to be nasty surprises in the results, with the confession season seeing ANZ, NAB and Westpac already taking out most of the garbage. The CBA marches to a different beat and dropped its full-year numbers in August, so profits under pressure. Aggregated cash profits of CBA, Westpac, ANZ and NAB 2014, 15, 16, here we go, peak, and then down to 2017, so it's below 2014 levels. So let's just have a look at this chart, which may shed some light. Nope, that's the patrons. This chart, which may shed some light onto why the bank's profit may have been higher in years past. That's to do with foreign investment, perhaps in our real estate and property sector. Could that be why we're having so much spruiking in the media all the time? Perhaps. Maybe there's just a reason why they want to keep pushing up property and encouraging people to jump into the market. So misconduct costs. The future of all the bank's profits will be steadily increasing provisions for misconduct. So the feature, sorry, not the future, but it is part of the future, isn't it? The CBA said its remediation costs have risen by another $1 billion this year. Just think about that, guys. $1 billion. How have these banks been behaving? Why is there no... the Royal Commission kind of just petered out, didn't it? When they wanted to throw more gasoline on the economy that is the housing bubble pretty much here in Australia, it just petered out. The NAB put it at $832 million, $559 ANZ, and last week Westpac said it was up for $341 million more, with the caveat that may not be the last of it. The total pre-tax costs the big banks have booked due to misconduct, including repaying ripped-off customers, hiring extra staff to tidy up the mess, new compliance cost, IT system upgrades. Oh, we've seen how CBA is handling that, haven't we? And paying lawyers to slug it out at the Royal Commission, have now hit $10 billion on figures compiled by Shaw and Partners. Well, I mean, just think about that. How much of it is going to go to us? So ANZ's $1.7 billion, CBA $3.4, including Austrac's $700 million money laundering counter-terrorism funding fine. NAB $2.1 billion, NAB 2.7, Westpac $2.1 billion. And yet, Parliament seems the need to push in a cash ban because us little plebs who dare to make a purchase with cash, and it may not be reported by the tradie we do business with. That is the real black market economy, not all of this. You know, if this is just what's come out of the Royal Commission, what haven't they discovered? Of course, this is pre-tax. The banks understandably prefer the post-tax metric, which cuts the damage significantly. Taking that approach, the bank's costs come in at $7 billion, assessed on an income that they shouldn't have booked in the first place, given it was derived from things such as charging for services not delivered and flogging dud insurance policies. As for the $3 billion in tax write-offs, viewed through a certain prism, that is the government paying back the money it should never have received either. It's cuts of the bank's scam. Yeah, as good as it gets. While none of the banks are expected to shoot the lights with their results, UBS bank analyst Jonathan Mott says it might be as good as it gets for some time. We believe the second half of 2019 will be a high watermark for the sector as the outlook deteriorates in an ultra-low rate environment, Mr. Mott told clients. Examining all the moving parts in the banks, Mr. Mott said underlying revenues were expected to fall by around about 1%. The all-important net interest margin, the profitable bit between the bank's borrowings and lending rates, will be a delicate balance between the benefit of a favourable bank bill spread and the drag of falling interest rates and more intense competition. The arm wrestle is expected to result in fairly flat margins. Not bad, not good. Credit quality is likely to remain stable, thanks to house prices rising again. That's questionable. But Mr. Mott noted all the banks' capital buffs remained under pressure, given further restraints placed on how these things are assessed by the prudential regulator. And here, dividends at risk, guys. And a lot of people have dividends, particularly in CommBank. In other words, banks will find it difficult to keep shoveling generous dividends to their shareholders in the current climate. Dividends remain at risk if interest rates are cut further, or QE is undertaken, Mr. Mott says. JP Morgan's Andrew Trigg agrees, and like Mr. Mott has taken the knife to forecast for impending dividends from both NAB and Westpac. Mr. Trigg said Westpac's ongoing customer remediation costs, higher capital requirements, and a potential AUSTRAC penalty were various straws about to break the shareholders' payouts back. So here we've got their shareholders. Well, there you go, this percentage change, everything down. Forecast, $1 per share. So, not bad. Not bad returns per share, but considering how much the shares cost at the moment. So RBA is to miss their inflation target again. September quarter inflation is generally a ritual sacrifice in consumer land. Booze and cigs up, or so went the headlines in days of yore, as the new financial year ushered in tax imposts hitting the hip pocket nerve. Add to that the annual increases in insurance premiums, rates and utility charges, and the third quarter gained a well-founded reputation for delivering an inflationary spike. This year looks a bit different. The market's view is headline inflation will rise by about 0.4% over the quarter to be up 1.6% over the year. The Reserve Bank's preferred measure, trimmed mean inflation, stripped out volatile items such as fuel and fresh produce, should deliver a similar sort of result. See, this is the problem. I've looked at this before as how they actually calculate inflation. And certain things aren't included, like existing properties, established properties, or land. You know, they're kind of big things that people purchase. If you included those in inflation, it'd be up 0.5 higher. Remember, inflation is a decline in your purchasing power, in the value of the money that you hold. Essentially, it's another tax in a way. So that inflation will be below where the RBA wants it should be no surprise. It is one of the principal reasons interest rates keep getting cut to new historic lows. The last time underlying inflation was in the RBA sweet spot was late 2015, while headline inflation has only briefly nudged above 2% twice in the past 5 years. So there you go. Wages remain the key to the puzzle. This is the thing. Why would wages go up? You know, you can't just switch a magic button on and drive wages up when so much of our workforce, a big chunk of our workforce, is dependent on the retail sector. You know, and that sector's declining as well. We've got a retail recession. So Morgan Stanley's Chris Nichols said inflation will remain subdued as the historically strong drivers, housing-linked and regulated prices, stay soft. Mr. Nichols had drilled into a decade's worth of data and found housing-linked prices, rents, construction and financial services, as well as regulated prices, utilities, rates, education, childcare and health, have contributed about 2/3 to CPI inflation, but over the past 2 quarters have been relatively benign. Good news? Yes, no, argues Mr. Nichols. Lower essentials inflation is a help to consumers, but not enough to offset the challenges of low and slowing wage growth and deleveraging, Mr. Nichols said. Lower prices, cheaper borrowing costs and tax refunds are great, but not so great as to drive a recovery in discretionary spending. The main headwinds remains wage growth, which is low and looks to be slowing, alongside an apparent deleveraging of the consumer in response to stimulus provided to date, Mr. Nichols said. Both of these factors suggest to us that more stimulus is needed to drive a strong recovery in consumer spending. But will it? How does the government spend its stimulus? We look at everything. It's mainly roads. Roads. I mean, come on, guys. There's only so much that will spread through. So will the RBA jump in again? Maybe, but not immediately. A slight tick down in September's jobless rate gave the RBA a bit of breathing space. However, a weak inflation rate of 0.3% over the quarter and the odds of day cut will shorten dramatically. Well, yes, we had that. Here you go, here's the contributor. We had that slight decline in unemployment, so I'd say that will push off another cut maybe for a while. Depends on how the next month's results are. Also, how effective is another cut going to be? I think the question is, will we get a cut or will we get the beginning of QE here in Australia? Let me know what you think will happen first in the comments, guys. It'll be interesting to see your perspective. So Fed to cut again. So yes, from a global perspective, the US Federal Reserve rate setting meeting this week probably outguns Australia's CPI data, with the unemployment rate at 3.5%, a 50-year low, monthly jobs numbers growing uninterrupted for almost a decade, core inflation at 2.5%, and the stock market at a record high. The US economy looks like a Wonka's idea of perfection, not too hot, not too cold. With that set of sweet numbers, holding interest rates should be a no-brainer for the Fed, but not a bit of it. The market is pricing in a better than 90% chance of a cut at this week's meeting. That shows you we're getting, I think, the reality of what's happening in the States, and the trade dispute between China and the US is going to have more of an impact than people realize. It's all going to flow through to us, guys. I mean, we'll bring up one of my favorite websites. You know, we're a iron ore, gold and coal producing nation, and we're shipping it to China and other countries. You know, guys, most of our trade's going to China. Most of their trade is going to America. It all flows through to us. I think it's going to have more. This will be more important to us than our jobless figures, to be honest. So it's what's being called an insurance cut, aimed at heading off hard landing or even worse recession next year. Where are they going to mention the not QE that's going on over there with the repo market? Doesn't look like it's mentioned in the Australian media, is it? Funny that. The Fed started taking out insurance early this year with a third cut that will take it right back to where it was when it started its post-GFC rate rising cycle in 2015, pulling its funds rate down to 1.5 or 1.75% target range may help ward off a recession, although it poses the question about what is left if it doesn't. So the markets chug higher, and that's just a bit of data how the markets are going. I'll let you read that in your leisure. But I honestly would think that the US data is going to have more of an impact on us in the long run than whatever we can do. We're an export nation, guys. Our economy is just too simple. If they want to create jobs and wage increases in Australia, there needs to be more encouragement for industry to establish here. We need to value add to everything we're creating, so we are not such a, our economic complexity increases. Guys, if there's a decline in demand for these products, there's going to be a decline in foreign revenue, and there's going to be a decline in tax revenue. Even just if iron ore drops down, the price of iron ore is affecting our budget surplus. So guys, let me know what you think. Where do you think it's all heading? Are you feeling sorry for the Big Four? I doubt you are. Take care, everyone. Like, share, and subscribe, and I'll see you next time.